Okay, let's unpack this. Imagine a world where the economic numbers you rely on, well, they might be dramatically off.
Yeah.
That's exactly what we're diving into today. A massive revision to U.S. employment data. And it could completely reshape the Federal Reserve's strategy and, crucially for many of you listening, send ripples across the crypto market.
It's fascinating, really, how deeply intertwined these things are. You know, things that seem totally separate.
Right.
We're looking at a rare moment where, like, data accuracy isn't just some technical detail. It's actually a catalyst for potentially significant policy shifts, market recalibrations. Our mission here is to navigate these complex connections, give you the clearest possible picture of what's happening and, you know, why it matters to your portfolio.
We've got a stack of fresh reports, expert analyses, even some real-time market chatter to sort through. Our goal: cut through the noise, give you the most important insights, and help you feel truly well-informed about this whole phantom jobs phenomenon.
And its powerful implications for Bitcoin, Ethereum, Solana, the big ones.
Okay, here's where it gets really interesting. Let's start with the big one. The non-farm payroll, or NFP benchmark revision. It's kind of like an annual checkup on the U.S. job market's health. What exactly is this, and why is this year's update causing such a stir?
Right. So the Bureau of Labor Statistics, the BLS, they usually estimate monthly job growth using a survey. It's called the Current Employment Statistics Survey, or CES.
Okay, a survey, so a sample.
Exactly. It's a sample.
Yeah.
But once a year, they do this benchmark revision. They basically check that survey data against something much more comprehensive. That's the Quarterly Census of Employment and Wages, the QCEW. Think of it like unemployment insurance tax records.
Ah, so much broader coverage.
Oh, yeah. It covers over 95% of U.S. jobs. It's considered the gold standard for employment data.
Right.
And this year's preliminary estimate, it just dropped today, September 9th, 10 a.m. Eastern, covers the year up to March 2024.
And the headline, what was the takeaway from this reality check? Did it match what people were expecting?
Oh, absolutely. There was a huge consensus beforehand, even from, Fed officials. They expected a significant downward revision. Mainstream estimates before the release, they were mostly saying minus 500,000 to maybe minus 1 million jobs needed cutting from the count.
Wow, even before the numbers hit.
Yeah. Fed Governor Waller, for instance, he summated around minus 720,000. Treasury Secretary Scott Bessent was looking at maybe minus 800,000. Some banks like BofA, RBC, they were projecting cuts near 1 million. The Bloomberg consensus was around minus 700,000.
So the expectation was already pretty dramatic. What was the actual number then?
The actual preliminary revision, minus 911,000 jobs.
911,000.
Yep. Confirmed a much, much weaker labor market than the previous data suggested.
1 million jobs just disappearing from the record. That's huge, almost hard to grasp.
So what does this all mean? Like, what caused such a massive overestimation in the first place? Well, it largely boils down to methodological flaws. In that CES survey itself, it often struggles with low response rates, especially from smaller businesses. And capturing new businesses opening or closing in real time, that's tough for it.
Makes sense.
And a big factor is the BLS's birth-death model. It's this model they use to estimate net job changes from businesses starting up or shutting down. The problem is it seems to systematically overestimate job creation, particularly when the economy slows down.
Ah, so the model itself has a bias during downturns.
Kind of looks that way. Some info we saw suggests it might have been adding like 40,000 to maybe 70,000 ghost jobs every single month.
Ghost jobs?
Yeah.
So the system designed to count new jobs was potentially just counting ghosts when things slowed down. Inflating the numbers.
Precisely. And add to that, the official unemployment rate, right now it's around 4.3%. That's generally seen as a lagging indicator.
Right. It tells you what happened, not what's happening now.
Exactly. The real health of the labor market was already showing cracks. Remember, August, NFP, only added 22,000 jobs.
Yeah, that was tiny.
And previous months kept getting revised down even before this big benchmark. Those were the early warnings.
Okay. Connecting this to the bigger picture. It feels a bit counterintuitive.
Yeah.
How did the market react initially? I mean, this sounds like news that should make the Fed ease up easier money, right?
Right.
So risk assets should rally.
That's a great question because no, the immediate reaction wasn't a super easy money party at all. Instead, we saw what's called a growth scare. Basically, Concern about a genuinely weaker economy took over.
So fear trumped greed initially.
You could say that. We saw the US dollar actually strengthen for a bit. Treasury yields were choppy. It looked like a flight to safety, not pure risk on. And it's that classic buy the rumor, sell the news thing. The market had already priced in a big downward revision, speculated on the Fed easing.
They front and ran the news.
Totally. So when the news actually hit, a lot of those long positions, especially in crypto and other risk assets, they got liquidated. A sell the fact event. Bitcoin, Ethereum, Solana, they all dipped initially, defied that simple expectation of an immediate rally. Yeah, reports we saw mentioned hundreds of millions in leveraged crypto longs getting wiped out in the 24 hours after the announcement. It's almost like the market, enjoys shaking people out right before a potential big move, tests their conviction.
Okay, so what does this mean for the Fed then?
Yeah.
If the job market is truly weaker, how does that change their calculus? Especially with the FOMC meeting coming up, September 17th, 18th?
Right. This confirmed weakness really shifts the Fed's focus. And remember, their dual mandate. It's not just inflation, it's also maximum employment.
True.
So for that upcoming FOMC meeting, a 25 basis point cut that's 0.25%, it's almost fully baked in by the market now, like 90% probability.
Okay, 25 BP seems like a lock.
Pretty much. But what's more interesting is the chance of a bigger 50 basis point cut, 0.5%. With the revision coming in over 900K down, the odds of a 50 BP cut jumped significantly. Some estimates put it over 60% probability now.
60%. That's quite high for such a big move. Why would they consider going that aggressive now? I mean, aren't there specific voices pushing for this? And doesn't a huge cut risk signaling panic? Maybe making things worse?
Yeah, it's a really sharp point. And yes, there are voices. Governor Waller has been quite outspoken. He basically said the Fed shouldn't wait for things to get worse, explicitly saying, let's start cutting rates.
Okay.
Chairman Powell, others like Williams, Bostic, Kashkari, they've also hinted there's room to ease. And this big NFP revision, it gives them what you could call objective data-driven cover for aggressive action, helps avoid accusations of, politics influencing them.
Right, the data made them do it.
Exactly. And to your point about panic, that's where this preventative cut idea comes in. The thinking is if the job market is deteriorating non-linearly, like falling off a cliff potential, maybe a bigger cut now, like 50 BP, gets them ahead of the curve.
Proactive, not reactive.
Right. To prevent a steeper downturn, instead of playing catch up later, it's a calculated risk, trying to show they're in control.
Okay, makes sense. Beyond September, what's the longer view? How much easing are we talking about?
Well, market intelligence suggests folks are pricing in about 75 to 100 basis points in total cuts by the end of 2025.
So 3 or 4 quarter-point cuts over the next year and a bit?
Roughly, yeah. And over the next 12 months specifically, maybe 100 to 150 basis points of total easing is kind of the mainstream expectation. Some places like ING, they're predicting rates could even fall to around 3.00, 3.25% by mid-2026.
Wow, that's a significant shift down.
It is, but there's always a but, right? The key risk here is sticky inflation. If inflation stays stubbornly high, or we get surprise oil price spikes or tariff issues, that could force the Fed to slow down the cuts, maybe even pause. That's the main wild card.
Got it. Okay, let's pivot to the big question for our listeners. Crypto, Bitcoin, Ethereum, Solana. What does all this Fed stuff mean for them? We saw the initial dip, but what's the overall link? How does Fed policy actually transmit to crypto prices?
Yeah, the connection is pretty fundamental, actually. It works through mainly 3 channels. First, lower real yields. When the Fed cuts rates, treasuries and other risk-free assets pay less. That makes non-yielding assets like Bitcoin or gold relatively more attractive because the opportunity cost of holding them goes down.
Okay, lower opportunity cost. Makes sense.
Second, a weaker U.S. dollar. Lower U.S. rates generally weaken the dollar. And since most major cryptos are priced in dollars.
A weaker dollar means a higher crypto price, mechanically.
Exactly. And third, more liquidity and risk appetite. Easier money means more cash sloshing around the financial system. That encourages people to invest in higher risk, higher reward assets. And crypto definitely fits into that category. It thrives when risk appetite is high.
Okay, those are the channels. But what's the historical proof? Does it actually work like that in practice? Or could you argue, that other things like institutional adoption or new tech matter just as much, maybe even more sometimes?
That's a crucial point. And yes, absolutely. Things like adoption and tech are vital for crypto's long-term value and story, no doubt. But when we're talking about market cycles, broad momentum shifts. Monetary policy is a huge driver. Just look at a chart of the Fed funds rate versus Bitcoin price, maybe on a log scale. You see a pretty strong negative correlation.
Meaning when rates go down, Bitcoin tends to go up and vice versa.
Generally, yes. Think back to March 2020, post-COVID crash. The Fed went unlimited QE, quantitative easing. What happened next? Massive crypto bull run. Bitcoin went the tightening cycle that started in 2022. That was a key reason for the crypto bear market that followed. So while other factors build the foundation, the start of a new easing cycle, historically that's been a powerful buy signal for crypto, an accelerator.
Fascinating. Okay, so let's assume these rate cuts do happen. What kind of price moves could we potentially see for BTC, ETH, SOL?
All right, let's game it out. Two main scenarios based on the upcoming Fed decision. Scenario A. The 25 basis point cut, this is baseline, mostly priced in. It confirms the dovish pivot. Based on history and current market structure, you'd expect maybe an immediate positive pop, then a steady climb through Q4.
Okay, specifically.
For Bitcoin, maybe a strong retest of that $120,000 $125,000 REO within, say, 1 to 2 weeks. Longer-term momentum could push towards $135,000. Ethereum could potentially outperform Bitcoin here, targeting $5,000 plus midterm. It benefits a lot from DeFi liquidity picking up.
And Solana, the high flyer.
Yeah, SOL's the high beta play, meaning it moves more dramatically. Could target $240, $275, challenging its old highs. Reflects that strong network growth and investor buzz.
Okay, that's the baseline 25 BP cut. What about the more aggressive scenario?
Right, scenario B, the 50 basis point cut. This would be a bigger dovish shock. It suggests the Fed is more worried, but it could also trigger a really sharp rally, maybe fueled by a short squeeze.
Explain short squeeze quickly.
Sure. It's when a price rises fast, forcing traders who bet against the asset, the shorts, to buy it back quickly to cut their losses. That buying pushes the price even higher, faster.
Got it. So in a 50 BP cut scenario.
Bitcoin could see a rapid push past 120K, aiming for that 135K target much quicker. Ethereum, potential for a melt up, like breaking $5,000 and targeting maybe $5,500, $6,000. And Solana, highest beta, could potentially rocket towards its all-time high, which is near $300.
Wow, big potential moves. Now this brings up something we've heard about, this beta ladder idea. How does money actually flow between these assets when confidence picks up?
Yeah, the beta ladder is a really useful concept for understanding capital flows within crypto during these cycles. Think of it like this. Initial money, especially from bigger players or institutions, often flows into the biggest, most liquid asset first. That's Bitcoin.
The safe crypto bet.
Kinda, yeah, it's the first stop. Then, as confidence builds, risk appetite increases. People start looking for higher returns. So, capital move down the risk curve, maybe into Ethereum. ETH has strong fundamentals, potential ETF flows, network upgrades. It starts to outperform Bitcoin.
Okay, BTC first, then ETH.
Right. And then finally, if we get into a real risk-on frenzy, speculative money looks for the highest beta, the biggest potential movers. That's when you see money flow into ecosystems like Solana, pushing SOL to outperform both ETH and BTC. It's about climbing the risk ladder as sentiment improves.
Makes sense. Okay, let's get specific with some intel from our sources on current price action. Where are the key levels people are watching right now? Liquidity zones.
Okay, looking at the reports, Ethereum's shown relative strength, testing recent highs. Support seems pretty solid, around $4,160 for $4,180. Liquidation maps those charts, showing where leveraged positions get force closed. They showed a cluster of long liquidations around $4,180 recently. Over 30 days, there was a bigger chunk, over $5 billion worth, down at $4,100.
So potential support levels. What about resistance or where shorts might get squeezed?
Short liquidations were clustered near $4,379 more recently. And looking out 30 days, there's over $1 billion worth sitting up around $4,832. So potential targets if it breaks higher.
Okay. What about Solana?
SOL's still looking strong, living up to its high beta rep, trading around $207 now. One source noted it's been falling less and rising more than others. Key support for Solana is seen down around the 195 to 206 SIPL zone.
And the king, Bitcoin.
For BTC, the liquidation maps over 30 days show a big cluster of short liquidations up around $114,300. That's over $5 billion. And long liquidations, a huge chunk, over $8 billion, is clustered down around $106,000.
So $110,000 looks like a pretty critical near-term level, maybe support.
Yeah, seems like a key battleground. And just a general trading thought here, those sharp sudden dips, those waterfalls, they're often designed to shake out nervous traders, the weak hands, before the real move.
Right, stop-loss hunting.
Exactly. So don't get too caught up in the minute-by-minute noise. Look at higher time frames, 1 hour, 4 hour, daily, weekly, to see the real trend.
Okay, this is super helpful. Let's get practical. For everyone listening trying to navigate this, what are some actionable strategies?
Yeah.
Short-term, medium-term.
Right. Based on the research, discipline is key. Maybe start with a light position before big events, like the Fed meeting, then add or reduce based on what actually happens. And always, always use stop losses. Protect your profits as price moves in your favor.
Okay, specifics for the short term, like the next few weeks.
For short-term event-driven plays, say 4 weeks, post-BLS, which already happened, if you saw that NAN 11K revision, the playbook was generally to buy the first decent dip, maybe add to BTC and ETH longs. If it had been way over NAN 11M, it would have been an immediate go long everything signal. If it had been a small revision under NAN 500K, that would have been a signal to close longs fast, maybe even consider shorting SOL because of its high beta.
Okay, what about post-FOMC next week?
Post-FOMC, sub 1718. If we get that 25 PP cut, maybe take some profit that sell the news reaction again, but keep a core position for the medium term because the easing trend is likely starting. If we get a 50 DP cut, that's a big bullish surprise. The play there is likely just hold everything, ride the momentum.
Got it. And for the medium term, say 1-3 months, how should people position?
For the midterm, thinking about positioning for this easing cycle, core portfolio. Analyses suggest maybe overweighting digital assets. A structure could be like 40% BTC, the anchor, 40% ETH growth, DeFi, 20% SOL, high beta speculation. Obviously adjust based on your own risk tolerance.
Okay, suggested allocation, how to get in.
Entry strategy. Don't go all in at once. Gradually build positions over maybe 1-4 weeks. Use pullbacks to add. Like if BTC dipped 3-5%, maybe add. If SOL dips 5-8%, maybe add there. Exit strategy. Take partial profits at key levels, like previous highs or big round numbers. And crucially, move your stop losses up as the price rises to lock in gains.
Excellent practical advice. But markets aren't risk-free. What are the big dangers listeners should watch out for? How can they protect themselves?
Absolutely. Risk management is paramount. The primary risk is definitely that sticky inflation we talked about. If CPI or PCE numbers come in unexpectedly hot in the next weeks or months, that could force the Fed to delay or slow down the cuts. That creates a stagflationary vibe, low growth, high inflation, which is usually bad for risk assets like crypto.
Mitigation for that.
Watch the inflation data like a hawk. If core CPI comes in way above consensus, that's a yellow flag, maybe time to reduce risk. The secondary risk was that the NFP revision could have been much smaller, a hawkish surprise. That would have killed the immediate bullish story.
How to protect against that kind of surprise?
Hard stop losses. Set them below clear technical support levels, like maybe below 108K for Bitcoin, just as an example. Protect your capital if the thesis breaks. And a trading insight here. Professionals know where retail stop losses are. They often push prices there to trigger them before moving the market their way.
So don't set stops too tight.
Consider giving yourself a bit more room. Yeah, maybe an extra couple $1,000s on Bitcoin's stop, for instance. Avoid getting wicked out unnecessarily. Also, think about rollover strategies. Instead of taking tiny profits all the time, maybe reinvest profits from one winning trade into the next potential setup. Let your winners run and compound in a strong trend.
Smart. Now, for those with a really high risk tolerance, what about the wild world of altcoins, the Shanzhai coins, as some call them? Opportunities and risks there.
Yes, the altcoin casino. Definitely high volatility, high risk reward. Research we saw mention a few that had huge surges recently, like WLD, HYP, Joke 8 MX. One MX apparently went from $4 to $18, like a 300% gain. It shows the explosive potential.
Huge gains possible, but the catch.
The catch is huge risk. Many altcoins have crashed spectacularly, like 90% drops or even more, gone to basically zero. The structural risks are massive. Lower liquidity means wilder swings, less transparency, often smaller communities. They're super vulnerable to sentiment shifts, or worse, outright scams or rug pulls.
So tread very carefully.
Extremely carefully. Therefore, tiny, speculative bets within a diversified portfolio only if you have a very high risk tolerance, and understand you could lose it all. Clear risk parameters are essential. So if we pull back and look at the big picture, this story isn't just numbers. It's a fundamental rethink of economic reality, right? and what that means for policy. The Fed's reaction, kicked off by these phantom jobs, it really could ignite a new cycle for risk assets, especially crypto. But as we saw with that initial dip, the market's reaction isn't always simple. Positioning, sentiment, it all plays a part in the short term.
Yeah, the challenge seems to be separating that short-term noise, the liquidations, from the potentially powerful underlying trend of easier money. So what does this all mean for you listening? It means stay informed, understand these different layers of market reaction, and definitely have a clear strategy. While the short term might give us whiplash, that underlying current of easier money could be a very strong tailwind for crypto. The key is telling the difference between the noise and the signal. And the real question, maybe the one to ponder, is this. As the Fed tries to manage the economy with this revised data, how will the market really distinguish between genuine economic strength and just policy-induced liquidity? And what weird feedback loops might pop up between those two? That's the question we'll keep diving into.